Great. Well, thank you, Shanaz, and good evening to you all. So I'm Nishad. I'm based in Singapore, and as Shanaz mentioned, I'm with Moody's Investor Service. So I'm part of the sovereign risk team, and I cover four countries. So I cover Vietnam, Malaysia, Maldives, and Taiwan. And since I cover Malaysia, I also cover the state of Sarawak in Malaysia. So I also cover state level credit. Um, and as Shanaz mentioned, we're former colleagues at Wells Fargo, so it's really an honor to be contacted by Shanaz and invited to do this. It's really a pleasure. So I thought I have maybe 10 slides or so, basically maybe 15 minutes or so or 20 minutes I can go through these. Please feel free to interrupt with any questions you may have or if anything is unclear. So I thought maybe I could go through these and then obviously we can have a discussion later on. So thank you for your time. As Shanaz mentioned, there's really three kind of main areas that I'll quickly go over. So first is, I'm not sure how much of you all are familiar with the basics of sovereign risk analysis. So I thought maybe I'll cover a little bit of that, though I'm sure many of you are quite familiar with the basic principles and how ratings are set and so on. But I can walk through that in a bit more detail. And then also just talk a little bit about my own career in case some of you are interested in sovereign risk and the kinds of background you may need to have or may wish to have if you're interested in a career. And I should mention, I'm in my late 30s and I only started working at Moody's in the last couple of years. So I have taken a long journey to get to where I am, including through Wells Fargo. So it can, it's something that people do straight from their university time or something that someone like me, I joined at, in the middle of my career. The next, I'll go through talk a little bit about some of the key risks that we're looking at. Obviously, lots to talk about on that front nowadays. And then finally, just a little bit about how, as a rating agency, we think about ESG, because this is obviously a hot topic as well, and something that is in a very early stage of where we're trying to integrate ESG into our rating process. Okay, so some of the basics of sovereign risk analysis. I just thought I'd have a few points here to mention. So a sovereign rating, of course, is a rating on the creditworthiness of a government. It can reflect a broader country risk, but in a sovereign risk, we're talking specifically about the government's ability to service its debt. And so there's certain unique characteristics about a sovereign that make it interesting from a risk perspective, credit risk perspective. And first and foremost is that typically the sovereign government is the strongest borrower in a given jurisdiction or economy. And this is because a government has special authority, special powers to issue debt, to borrow from the market. And unlike a corporate or a bank, they can change the laws. They can do different things to permit to permit greater borrowing and incurrence of debt. They can also, of course, tax the economy to raise revenue in order to service that debt. So again, unlike a corporate or a bank, they may be able to raise interest rates on their borrowers or raise prices on their customers to collect revenue, but ultimately there may be competitive pressures that prevent them from doing so. A government, of course, can pass a law and has executive authority to influence the taxation in the economy to be able to force people, essentially force actors in the economy to pay tax. Second point, which is very important also in the realm of credit risk, is that if a government defaults, there is no higher authority to compel repayment. So there's no, when Argentina defaulted recently, there's no international authority that says, Argentina, you must pay your creditors in full. And so therefore, typically, to my first point, sovereigns do tend to have the lowest credit risk because uh, uh, they basically are there's no one telling them that they must repay, and but they also have a high probability of survival after a default. So taking Argentina again, when they defaulted, the country does not disappear, the government does not disappear, and so there's a lot of strength built into the credit risk, just given that they have these special authorities. And then finally, as a rating agency, when we look at the sovereign rating, it provides a very important benchmark for other borrowers in the country. So for example, in many countries that we rate in Asia Pacific specifically, there are a lot of state-owned banks, state-owned enterprises, local governments, which are tied to the government, and therefore we may assign a baseline credit assessment. So the intrinsic credit quality of a bank or a company, but then it may receive some uplift based on the government support level. So if it's in one of the countries I cover, Malaysia, there are a lot of what they call government-linked companies that are strategically important in the oil and gas sector, for example. And in these cases, we assume very high levels of uplift to the credit rating from the sovereign because of our assumption that the government will essentially support them in times of liquidity stress or other other periods of stress. So the sovereign is very important from a risk perspective. So that's the first point I wanted to mention. Now, how did sovereign risk look during the pandemic? And this is a question we get a lot from investors about how do we think about sovereign risk because of COVID, and also how, going forward as we move past this period of the worst period of COVID, and now that we're starting to manage it globally and countries are opening up. And I think if we had to generalize the credit rating changes that we made during the pandemic, I would say if we had to categorize all of them, it's really that they were driven by really ultimately an impact to liquidity for the government because of either the closure of the economy, so contraction of economic growth in many countries, or because of effects to key sectors like tourism. The governments had to their revenue base was substantially weakened, and they had to run higher fiscal deficits, and therefore had to borrow and incur larger quantities of debt, and that also stressed their liquidity as well. And so when we look globally, the countries that we did downgrade, I would say it's really the liquidity pressures that came from COVID and the lockdowns and all of those things that really prompted sovereign downgrades. Now, in some cases, in Asia Pacific specifically, I would say the downgrades that we undertook are really, for the most part, tourism-dependent economies. So as I mentioned, I cover Maldives, so we did downgrade the rating of Maldives by 1 notch. And I also used to cover Fiji, another country that's very highly dependent on tourism. And in that case, we also downgraded by 1 notch, really because of the impact of the border closures and lack of tourism for almost 2 years on these economies. Now, Maldives has actually performed much better. As I'm sure you're aware, the border reopened quite early, and tourism arrivals are now back to nearly pre-pandemic levels at this point, whereas Fiji is still a bit later on in a later stage. So those are some examples in the Asia Pacific region where we took downgrades very early on during the pandemic. Now, as the pandemic has gone on, we've started to see stress appear in some of the weaker rated countries like Laos, for example, Pakistan. We have a negative outlook on Pakistan now. We also downgraded, I believe, we've had negative outlooks on Mongolia and some of the weaker countries that are on the weaker end of the rating scale. And so you might expect that countries that have weaker ratings may come under pressure more quickly because of some of these liquidity pressures or debt pressures that have emerged. But I think another key message, though, is that the region was broadly stable. So aside from those examples that I mentioned, um, we see that among the regions globally, Asia Pacific was one of the most stable from a ratings perspective. And so I think one message that we've also tried to send to the market is that higher debt levels does not necessarily mean a downgrade. We saw during the coronavirus pandemic that many governments were implementing large stimulus packages, for example, or because of the shortfall in revenue, their fiscal deficits were very large. So we didn't necessarily downgrade all countries because of that pressure. So I think that's one key message. And a big reason for that is that while debt levels rose, we did see that interest rates came down significantly. Not only because central banks were easing policy, but also because of excess savings. You know, people were not spending money, people were in lockdown. There was a surge of savings globally. And so we also saw that helped to keep interest rates low as well. So from a government financing perspective, governments were able to finance these large deficits with relatively low cost, generally speaking. The second point I think is that there was a lot of resilience in economies despite lockdowns. And I think this is, again, unique to Asia, where many countries are export-oriented economies like Bangladesh. And so even as the domestic economy was locked down and closed down, many countries were able to export. And we look to China. Of course, China came out of the pandemic very early and was able to start its manufacturing quite quickly in 2020. But also Taiwan, Vietnam, Malaysia, Bangladesh, a lot of these countries that are very much driven by export growth and exports. And in the West, you know, we saw in the US and in Europe, there was a lot of stimulus that was being provided, and so the demand side was also very strong. So there's quite a lot of resilience because of this favorable trade environment after the worst of the lockdowns in March or April of 2020, when manufacturing started to reopen at that stage. And to my earlier point on tourism, I think this is important for Asia because we do have a lot of countries that are dependent on tourism. I mentioned Maldives and Fiji, but even Vietnam, Thailand, of course, is very heavily dependent on tourism. Malaysia, Japan also has been, until last week or this past week, has been very closed to tourism, very restrictive. So there's a lot of uncertainty in the sector within Asia, and we've seen that the recovery's been uneven. And this is an important sector for many economies in terms of driving the services sector growth. So I think this is something that we'll continue to watch and will be an important driver for growth in many of these countries in the region. Now, I thought I just, for some of you interested in sovereign risk work, I thought maybe I'll just quickly go through kind of my day-to-day daily job and give you a sense of what the kinds of things that we do as a rating analyst. So firstly, as I mentioned, many types of professional backgrounds are on my team. So I have colleagues who are former investment bankers, colleagues who are former economists. In one case, I have a colleague who is interested in political risk analysis. So basically, there's a lot of different backgrounds. Former journalists, including myself. I used to be a journalist in my when I came out of university. So there's a lot of different backgrounds. Now, in terms of the role itself, basically the key aspect of the ratings we set is to develop a forward-looking view. So the rating is intended to signal to the market how we see credit risk in the next 1 to 2 years, basically, and not based on what has happened or what has transpired. So related to that, we do my apologies. Um, my job responsibility as an analyst is to also provide a recommendation on a rating and outlook for a specific country. Now, how do we gather this information for our analysis? Firstly, we do meetings with issuing governments. So my role is to meet with the ministries of finance or the central bank, as well as the local officials from the World Bank and IMF and Asian Development Bank, and get a view on what's happening in the country. And until this year, we couldn't travel, but now part of my role is to also travel to these countries and meet with the officials and get a sense of the on the ground view. Next is monitoring data and policy announcements in the news and just get a feel for what's happening. But then we also do external facing type work, so outreach like conferences, investor calls, research, and then finally we also, of course, to my point earlier that sovereign ratings can influence the ratings of banks or corporates in that country. We also have to coordinate with the other rating groups, other lines of business that are doing ratings on corporates and banks in those countries. Okay, now I'll just walk through maybe some of the top risks that we're looking at looking into next year. And I think there's really 2 or 3 key ones that I think are very clear to all of us. And it's really uncertain to see how things will play out next year. But first and foremost is that we will see weaker economic growth globally, and weaker economic growth most specifically in the large economies of the globe. So first and foremost, the US and the Euro area. There's a lot of pressure on economic growth at this point, given the way inflation has risen. And in the case of Europe, the Russia-Ukraine military conflict has created a lot of pressure on commodity prices and supply, which could put significant pressure on economic growth in the Eurozone next year. This table, I know it's a lot of data, but basically I'd like to point out here in the middle is our growth forecast at Moody's. So every few months we update our global macro outlook, which is a forecast of the G20 economies, so the largest economies globally. And here you can see that we've reduced our GDP forecast for the US to 1.9% and actually slowing down next year to 1.3%. Similarly, for the Euro area, next year we expect very modest growth of only 0.3% growth in the Euro area. You look across, here we have more specific economies of Europe like Germany. Germany, we actually expect a contraction given the energy supply issues. And then, of course, Italy and France, very weak economic growth next year. Even turning to Asia, it's quite stark. I mean, in China is of course the big question. How long will China pursue its zero COVID policy, in which they've been very restrictive with lockdowns? Even still, our view is that after the 20th Party Congress in China, which is next month, there may be some additional policy support to the economy, perhaps some relaxation of the zero COVID measures, but still very uncertain. We don't know what the intentions of the government are. Related to that, of course, are the property sector, property market downturn issues in China, which has very large spillover effects to the economy, which, given that I think between 20 and 30% of GDP in China is tied to construction or property, real estate development. So very important and significant sector. We also see, even in India, India's growth will be below potential next fiscal year of around 5%. So still relatively low compared to India's kind of 6 to 7% potential growth. So really slowing growth and also elevated inflation. Our view is that inflation has peaked, most likely, in the key advanced economies. But nevertheless, I mean, if we look at the forecast we have for inflation, this year 7%, next year 2.3%, but that's given the base effect. So we still expect price levels to remain very, very high based on recent standards. And of course, you see fairly high levels of inflation that we expect in the Euro area economies, again, driven by the energy price issues and the supply issues given the Russia-Ukraine military conflict. Now in Asia, we haven't seen inflation, of course, in some countries, like Bangladesh or Pakistan, increasingly in Southeast Asia, we started to see inflationary pressures start to rise. And, governments here have been able to manage it so far because of fuel subsidies or electricity subsidies, also tax cuts. In Vietnam, for example, a country that I cover, the government has cut the environmental tax several times on petrol to help manage fuel price inflation. But if commodity prices remain elevated next year, then that could start to present a very difficult picture for even in Asia, because to this point, the employment situation, the domestic demand pressures within countries in Asia has started to recover this year. But next year, we expect many countries in the region to reach full employment, and you will also start to see demand side pressures on inflation and core inflation pressures. And so that could start to create a risk for central banks to have to react more swiftly to those risks. And related to that, of course, is the direction of interest rates. And this is where we may start to see external pressures and external financing conditions weakening and worsening for the weakest rated countries in Asia Pacific. And we've already seen that in the case of really the countries that have very high levels of external borrowing in the capital markets, and also are already have weak fundamentals. So Laos, for example, Pakistan has an outstanding issuances. Maldives is another case. Sri Lanka, of course, is already defaulted. So we're going to start to see additional pressure on these particular countries as the U.S. continues to hike the monetary policy rate. Same in Europe and in the UK as well. And even Japan has we saw this week that the Bank of Japan has started to defend the yen. But even then, the monetary policy in Japan has been still very weak and accommodative. But that would be interesting if Japan starts to also tighten policy. That could send a very strong signal, that a hawkish signal to the market, that even if Japan begins to tighten its interest rate. But here I'd like to show our forecast for the key policy rates for the advanced economies. And so we expect the federal funds rate really to peak in early 2023, and then allow some space for the Federal Reserve to start easing policy, but at a higher level into 2024 and 2025. So there's still quite a number of rate hikes that we expect in the US. Different story in Europe, of course, where despite the Russia-Ukraine pressures, the central bank has been hiking quite aggressively because of the inflationary pressure. But we think that they will be able to level off at a lower level, and similarly in the UK as well. And then a final risk is looking at uh, the long-term effect of higher debt levels in the region. And as I mentioned earlier, we don't necessarily downgrade countries because their debt level has increased. There's many factors that may go into a rating. But nevertheless, we see that debt, if you look at the debt share of GDP across the region, it has, in a sense, permanently increased because of the pandemic. And here on this chart, we show, if you look at the green bar, that's basically the change in percentage terms in the debt to GDP ratio between 2019, so from before the pandemic, until the end of 2022, based on our current forecasts. Then the blue column shows the change in debt between our forecast for 2022 and 2024. So how will debt to GDP decline or increase in the next 2 years as economic growth recovers and as governments start to bring their fiscal deficits back under control? And essentially, I think the main message here is that very few countries will actually see a decline in their debt level as a share of GDP through 2024. And so this will have consequences for interest payments. And as interest rates rise also, the actual cost of that debt as governments start to refinance or reissue new debt. So this is a risk that we're looking out for. I mentioned the likes of Maldives and Fiji here on the far left. Tourism-dependent economies where essentially their GDP contraction was so severe that their debt burden, in the case of Maldives, increased by 40 percentage points. Same for Fiji as well. But as those economies recover, and as I mentioned, Maldives tourism recovery has been very strong, that debt level should start to come down more quickly. But if you look across the others, Southeast Asia, some of the other advanced economies, Korea, Japan, significant increases in debt and no scope for decline. Now you see Bangladesh here is around less than 10%, but we do expect that the government will keep a fairly expansionary fiscal policy. And so the debt burden, we do expect to continue to rise. But still, from a relatively low base, the debt level in Bangladesh has historically not been very high, but we do expect it to rise. Okay, and the final risk is really political and geopolitical risk, which is always there. It's always, I'm sure Shanaz can remember me talking about this at Wells Fargo when we did country reviews, and we always talk about political risks. Really, this is definitely something we need to watch out for. On the domestic front, we've seen social unrest in countries like Sri Lanka and Pakistan because of some of the economic pressures, and in Sri Lanka's case, the default issue and the financial challenges. So this is something that's very real that governments are watching out for, and as a result of this risk, many governments may feel pressure to keep spending keep spending on social programs to support the population to prevent any kind of social unrest. And then another kind of macro trend that continues to be a force in the region is US-China tensions and the US-China relationship. We saw very recently the risks around Taiwan with the military exercises that China conducted and the visit of the US officials to Taiwan. So the relationship between US and China is becoming more polarized. We also think that because of zero COVID and the tariffs on China, companies will continue to shift their supply chains and production outside of China to other locations because of geopolitics, but also because of cost. It's maybe cheaper to move to Vietnam or to Bangladesh or to Malaysia than to produce in China. And related to that, we expect to see companies and governments reshoring their most critical supply chains for products like semiconductors, for example. Even if it's more costly or if it's redundant, they will start to move those supply chains locally so that they have access to those critical components like chips. And this is part of a broader deglobalization trend that surely you all have read about, and there's been lots of analysis about this emerging trend. And then also the US itself is trying to increase its economic presence in the region through new trade frameworks and new attempts to try to bring different countries together to discuss trade and other integration. But China, in our view, remains the key economy of the region, just given its size and that it has become the main trading partner for most countries, if not all countries in Asia. Okay, I just had one more slide on ESG, and then look forward to any questions. ESG is environmental, social, governance issues is has become very popular, very important issue, and very much integral to the planning that financial services companies are doing to respond to the market demand that has emerged. In the case of sovereign rating, our approach has, I would say, previous to 2019, our approach was in a rating action, we would explain how ESG factors may have influenced our analysis. And it was essentially one or two paragraphs in a press release that we would produce. But increasingly, we want to provide more transparency to investors and to issuers as well, how we're thinking about ESG and how it influences our ratings. So we do now have a scoring system at Moody's, and we essentially assess on a scale of 1 to 5 the impact of ESG factors on the current credit rating. So if we take a country like maybe I'll take Maldives, since it's an island country, exposed to rising sea levels, for example. We actually have a score of 5 for environmental risk exposure, which is quite self-explanatory. And in our view, what that means is that environmental risk has very highly negative impact to Maldives' credit risk or credit profile. And 1 is positive, meaning a country like Singapore, for example, we assess that governance, they have a governance score of 1, which means that governance actually has a positive influence on their ESG or their sovereign credit profile. So we are trying to provide more empirical or numerical assessment of countries on their ESG credit risk. Now, not surprisingly for sovereigns, governance tends to be the key driver because, first of all, we have a score in our methodology for governance, so it's already embedded in what we're analyzing. But also, governance is very important for a country in terms of addressing environmental and social risks. So you will find that many of our rating actions that may be driven by ESG factors tend to cite governance as the key driver. But we do see that environmental risk is increasingly becoming a part of our key drivers. For example, we recently upgraded Vietnam by 1 notch in our sovereign rating by 1 notch. But we did mention that environmental risk is increasingly becoming relevant to Vietnam's creditworthiness because of exposure to typhoons, exposure to sea level rise, and it is an investment the government will need to make in the very near term. So from a credit perspective, it's very relevant. It's very much relevant to their ability to service their debt essentially over time. So that's one example I could give. Now, another aspect of this is we also want to bring ESG into our actual issuer meetings. So meetings with the governments, and we are starting to ask more questions about what is their plan for net zero, for example, carbon transition, migrating to renewable energy sources. How are they addressing social risks as well, like income inequality or uh, economic scarring from the pandemic? So we're not only are we trying to integrate ESG into these scores and into our rating process, but also in the uh, actual information gathering that we do with the issuing governments. And I would say we found that many governments are quite open to these discussions. Uh, they're starting themselves to also think more closely about ESG risks. So I think it's been an interesting 1 or 2 years where we've started with the scores, and now we're starting to get more understanding from the governments themselves as to how they're trying to address these risks. And then a final point, this is very important because we get a lot of criticism from the market on our scores, and some of it is fair, but some of it maybe not fair, because our scores are not meant to describe um, uh, sustainability practices, or there are many ESG scores in the market that assess a company on their sustainability practice or how environmentally friendly they are. That is not our role. Our role is to strictly think about ESG and how it affects the credit risk first and foremost. So we have a fairly narrow view of ESG and how it influences and how we think about scores and how it influences the credit rating. So I know that's a lot, and thank you for your attention. And I would be happy to discuss or take any questions or get any views. Thanks a lot.
Thank you, Nishad. I think that was an excellent presentation on the topic. You've covered so many important things. I'm sure our participants have really enjoyed this past almost an hour. But I don't want to prolong my comments, but I like to give the audience or the participants the opportunity to ask any question if they have. In the meantime, I like to just ask you with your final piece, that was the ESG factors, sounded very interesting. So is it an evolving thing, right? Do you expect that as we as year go by and we are seeing the climate risk or the whole ESG piece being addressed in a more higher level, and even by countries like United States itself, do you feel that there will be more pressure on the credit rating agencies or companies to rate sovereign risk in a different way, or include it in a broader way?
Sure, definitely. I think so. This is just the work that we've done so far is really only the starting point, because we there first of all, I think the scores themselves are scale of 1 to 5 is very basic scale, so it's hard to get a feel for differentiation in that scale. So I think really the next step is to provide more granular or specific assessments of risk. So, and this is where, as a company, we're trying to acquire data providers and companies that can provide, let's say we look at Bangladesh or look at Vietnam or United States and identify parts of the country that are most exposed to flooding or to storms or any particular environmental or climate risk, and be able to specify that what percentage of the economy is operating in this specific region, what are the adaptation investments that the government has made or is making in that specific region. There's so much interesting data that we can make these scores more specific and make them more granular, so that if you're an investor, you can say, okay, if I'm looking at Vietnam, Southern Vietnam is exposed to these kinds of risks, Northern Vietnam has these kinds of risks. 20% of GDP is focused in this part of the country. Um, how does that influence overall economic risk to the economy or risk to the government's finances and so on? We can start to model those things more specifically on a country level basis. So I think that's definitely one step that we're likely to take. And then on the country level, I think there is so I think the net zero announcements is something to watch, because to this point, outside of China, I would say, in Asia, I think few countries have started to actually implement their plans for net zero. I mean, every country has a net zero target now, but in the next 1 to 2 years, we will start to see uh, governments start to implement these targets. And from a sovereign risk point of view, it's very interesting because on one hand, you have exposure to climate risk, which can be credit negative. It does negatively affect the credit of a country on a net basis. Um, but if you're also a country that's adapting to renewable energy, reducing the carbon intensity of your electricity generation, that could be credit positive in a sense. So we'll start to think about how do these credit pressures offset each other, if a country is starting to make that transition more quickly and more effectively. So yeah, I hope that
Okay.
answers your question, Shanas. Yeah.
Yeah, thank you. So again, we have a question. Could you share your thoughts on the impact of LDC graduation of Bangladesh on its credit?
Yeah, it's a very good question. Yeah, so I think so. With the graduation, of course, the government will be borrowing less from the most concessional windows, and I think we do see that as a potential risk, in that the alternate sources of finance would have to either come from domestic, right, the domestic banking system or the domestic capital market to the extent that it is developing, um, or it may come from, of course, external commercial lenders, capital market financing, or it could come from bilateral partners. And I think for Bangladesh, it's I almost look to Vietnam as a good model, where Vietnam graduated from LDC status very recently as well. Very similar kind of economic model in a sense that it's export driven. A lot of started with garments and moved up the value chain over time through FDI. I almost see Bangladesh as a similar path in terms of moving up the value chain in the export sector, and that's allowed the domestic savings to build up, domestic capacity, and so they were able to transition from uh, IDA, the LDC windows, the concessional windows of finance, and move towards more domestic banking system, domestic capital market finance. So I think it is a risk for Bangladesh, certainly, but on the other hand, there may be, given that it is a high growth economy, there is potential for, as domestic savings build up, to switch essentially more towards domestic financing.
Wow, great response. Um, while we wait for more question, I like to ask you something. You mentioned about beginning of next year, right? We are expecting some bumpy rides, with the interest going up, the inflation, employment. We hear a lot about a unique kind of recession, which is, there. Um, and what are your views on this unique kind of recession that is being discussed?
Yeah, it's it's very interesting. I think so. It's unique, I think, in a sense that we've just come off a very severe. First, it was a supply shock from COVID, and then it became a demand shock when countries locked down. so you had the supply shock from Asia, basically China locking down, then the global demand shock as Europe and US locked down. And then finally things normalized. We entered a recovery stage. Then you have another supply shock from Russia, Ukraine, and also China's lockdowns. Um, and now you also have a potential demand shock on in the advanced economies as inflation rises. Uh, what's interesting though is you see that the labor market is still quite strong in the US. And you look at retail sales are still very strong. Some of the so these high frequency indicators are showing that there's still quite a lot of savings in the economy. There's still quite a lot of job growth. There's still I think maybe that cycle is peaking now. But we may enter next year with perhaps, I think, maybe an upside surprise in the sense that inflation may come down faster than we expect, and the labor market may be stronger than we may expect. So I think it's there's so much uncertainty, I think, because um, the 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 way interest rates have come up, I mean, there inevitably will be an impact on the economy. But just given the strength of some of the data more recently, it is possible that it is a very shallow kind of recession or a very shallow point of weakness. Um, so that's one thing. I think China is also a big factor here because uh, it, we don't know how China will approach the zero COVID policy next year, and the property sector uncertainty is also there. So I think it's and China is a big source of global growth. Of course, 30% of global growth comes from China's growth, essentially. So that actually may be more important and more uncertain than the U.S. trajectory.
Sure. So we have a couple of questions. I just like to quickly go over those. So the first question we have from Shanaz, also my name. What are the factors to get Moody's credit rating for a Bangladeshi local private bank?
Sure. That is a question that my commercial colleagues would have to deal with. Unfortunately, I can't answer that directly. There's a process. Essentially, you would reach out to our commercial team, and if that's something that's of interest. Yeah, sorry I can't offer more on that front.
Sure.
Yeah.
No worries. We have
Yeah.
another question. It's from Shireen. Excuse me. So she's saying, I wanted to ask about the loans from multilateral organization that Bangladesh, Pakistan, and Sri Lanka is taking. What will be the outlook on that as those loans come with certain conditions which are said to be detrimental for the economic rebound in this inflationary phase? Wow.
Yeah. Good question. Yeah, I think so. In the case of, I mean, I would obviously Pakistan and Sri Lanka are in much different situations from a macro perspective, in my view. I mean, Sri Lanka is, unfortunately, has gone through very, very severe issues, and so I think the IMF program, for example, I think was a necessary to manage the financing pressures and the external balances. Similarly with Pakistan, I think in Pakistan's case, interestingly, they've used the IMF programs to drive domestic reform. So, and we've also seen that typically when Pakistan is able to renew the IMF program, it's other creditors come in. So I think, and similarly for Bangladesh, I would see the IMF outreach as kind of a defensive, preparing for the worst kind of thing, in the sense that it's preempting it's not necessarily because there is a genuine crisis, but it's really just as a buffer. And in the case of Bangladesh and Pakistan, I think the reforms that the IMF and others request are definitely difficult for governments to undertake. But I think perhaps on the positive side, it does help to stabilize the external outlook, if you will, and provide some confidence to other creditors. So I think it is a bit of a mixed picture on that front. Yeah.
Thanks. That was really great. I have another question because, I mean, under the present circumstances, the counterparties, of course, you look after sovereign risk, but banking industry plays a very important role. We all know that. Under the present circumstances and with the, unique recession coming up, what would be the top 3 key risks from the banking industry that could affect the overall, sovereign risk?
Sure. A tough question, Shanas. Um, I think so. I think first and foremost is uh, on the trade side, or I guess on the macro picture is um, definitely very important in the sense that um, obviously if you have a more rapid tightening of interest rates in the advanced economies, we have seen that there have been capital outflows from certain countries in Asia that have relatively open capital accounts, and that can have effect on domestic liquidity conditions, of course, and could affect the domestic banking system. So first and foremost, monetary policy and the reaction that domestic central banks also have to take to react to that. Secondly, on the asset quality front, I think a lot of the banking systems in Asia have strong linkages to the government, to the sovereign, and so uh, I think largely speaking, most banking systems have been able to have some level of forbearance because of COVID, and now they're starting to move beyond that. And the asset quality stress from COVID is starting to show up in the NPL numbers and so on. But I think as economic conditions worsen, you're naturally going to have a rise in NPLs, depending on the economic conditions, and that may require capital support from the government, which is something that we watch for, of course. And beyond that, I think, yeah, I would I would leave it there. I mean, that's a good question, Shanaz. I have to think more about that.
Thank you. Thank
Yeah,
you.
yeah.
No, I think you really covered it all because capital outflow, NPLs definitely could affect the overall sovereign risk significantly. So I think that, we've reached almost, we're at the top of the hour. It's 8:30, your 10:30. And I sincerely like to thank you, Nishat, for, accepting our invitation to speak in one of our webinars. We will be covering more hot topics. So please, stay with us, all of you, in future. And so if there are no more questions, we just have 2 or 3 minutes left. If not, then, we like to let Nishad go back to his family. So thank you so much, Nishad.
Absolutely. It was an honor, Shanaz. Thank you for the invitation, and very nice to meet you all.
Thank you so
Yeah.
much. Thanks to everyone who have joined. It's a weekend, so thanks again. Okay, with
Okay.
that, bye-bye to all.
Bye.
Bye.